Right now, somewhere in Jakarta, someone just paid for coffee with their phone. The money left their account. It arrived at the cafe, 2 seconds, maybe 3. But here's what actually happened. That money didn't move. Not really, not the way you think, because money doesn't flow through the economy like water through pipes. It doesn't travel from person to person, bank to bank, like some digital relay race. What actually happens is stranger. And the difference between what we think happens and what really happens is the reason economies collapse. Let me show you.
It just keeps rising.
We talk about money moving all the time. Consumers spend, businesses invest, banks lend, central banks inject liquidity. Money flows, we say, it circulates, except it doesn't. When you paid for that coffee, your bank didn't send cash to the cafe's bank. No actual thing moved between institutions. Instead, your bank made a promise. The cafe's bank accepted that promise. And somewhere, in a system most people have never heard of, those two banks settled the difference at the end of the day. This matters more than you think, because when people talk about a safer economy, about preventing the next financial crisis, about stopping bank runs or currency collapses, they're really talking about one thing: trust in this system of promises. And that system runs on something most of us never see. Let's start simple. You have $1,000 in your account. You think that money is yours sitting there, waiting. But open your bank's balance sheet. That $1,000, it's a liability to them. They owe it to you. They promise you can withdraw it whenever you want. Now here's the trick. They don't have it, not sitting in a vault, not in cash. They lent it out to someone buying a house, to a business expanding, to another bank that needed liquidity overnight. Your $1,000 is simultaneously in your account and in someone else's mortgage. This is called fractional reserve banking, and it's not a secret. It's how the system is designed to work. But here's where it gets interesting. When you spend that $1,000 on rent and your landlord banks at a different institution, your bank now has to actually pay up. Not with your original deposit. That's long gone. But with reserves. Reserves are the real money. The stuff banks hold at the central bank. And there's way less of it than you'd think. In Indonesia, banks are required to keep around 9% of their deposits as reserves. In the US, before 2020, it was 10%. Now it's 0. Let that sit for a second. 0. So when trillions of dollars change hands every day, when your salary hits your account and you pay your bills and businesses move money across borders, none of that requires actual reserves until the end of the day. Until settlement. Settlement is when the promises get reconciled. Every bank in the country tracks what it owes and what it's owed. At the end of the day, they net it out. If your bank sent out more money than it received, it has to transfer reserves to cover the gap. If it received more, it gets reserves. This happens through something called a real-time gross settlement system. In Indonesia, it's called BI-RTGS, managed by Bank Indonesia. In the US, it's Fedwire. In Europe, TARGET2. These are the pipes, the actual infrastructure where real money moves. And almost nobody thinks about them until they break. But here's the uncomfortable part. If a bank doesn't have enough reserves at settlement time, it has a problem. It can borrow from other banks overnight. It can borrow from the central bank. But if it can't do either, it's insolvent. And insolvency spreads fast because banks lend to each other constantly. Overnight loans, interbank markets, repo agreements. The entire system is a web of IOUs, and every bank assumes every other bank will make good on their promises. When one bank fails, the others suddenly realize they're holding worthless IOUs. This is what happened in 2008. Lehman Brothers collapsed, banks stopped trusting each other, interbank lending froze, and suddenly even healthy banks couldn't settle their payments because nobody would lend them reserves. The system didn't run out of money, it ran out of trust. So central banks stepped in. They flooded the system with reserves. The Fed, the ECB, Bank Indonesia, everyone. They became the lender of last resort, not just to banks, but to the entire settlement system. And it worked, kind of. Markets stabilized. Banks started lending again. The pipes unfroze. But here's the irony. To save the system, central banks had to prove the system doesn't actually need to be safe. Because if you know the central bank will always provide reserves in a crisis, why bother being careful? This is called moral hazard, and it's the quiet cancer of modern finance. Banks take risks because they know they'll be bailed out. Businesses over-leverage because credit is cheap. Consumers borrow more because rates are low. Everyone operates as if the money will always move, because it always has. Until it doesn't. Let's zoom out. The global financial system processes over $5 trillion a day, most of it through a handful of settlement systems. SWIFT for messaging, CHIPS and Fedwire in the US, BI-RTGS in Indonesia, Target 2 in Europe. These systems are centralized. They have single points of failure, and they're only as strong as the weakest link in the chain. During the pandemic, transaction volumes spiked. Remote work, digital payments, cross-border commerce. The pipes handled it, barely. But stress tests show that a major cyber attack, or a sudden liquidity crisis, or even a technical glitch at the wrong moment, could freeze trillions in mid-flight. And when settlement stops, the economy stops. Not slowly, not gradually, instantly. Because modern commerce runs on the assumption that money moves, that payments clear, that promises are kept. Remove that assumption, even for a day, and you get bank runs, capital flight, collapse. So governments and central banks are trying to make the system safer. They're increasing reserve requirements, stress testing banks, building redundancy into settlement systems. Some are exploring central bank digital currencies, which would let people hold money directly at the central bank, bypassing commercial banks entirely. But here's the question nobody wants to answer. Can you make a system safe when the system itself is designed to be fragile?
Run!
Because fractional reserve banking requires trust. Interbank lending requires trust.
Don't touch the pipe.
Settlement requires trust. And trust is the one thing you can't regulate into existence. You can force banks to hold more reserves, but that makes lending more expensive. You can make settlement systems more robust, but that makes them slower and more costly. You can eliminate risk, but you also eliminate growth. The safer you make the system, the less it does what it's supposed to do. Move money, allocate capital, fund the future. So here's where we are. Every time you make a payment, you're participating in a system held together by promises. Those promises are reconciled every night through settlement systems most people will never see. And those systems are backstopped by central banks printing reserves out of thin air. It works until it doesn't. And the uncomfortable truth is this. We've built an economy that depends on money moving instantly, frictionlessly, constantly. But the infrastructure that makes that possible is older, slower, and more fragile than the economy it supports. One day, maybe soon, maybe not, that gap will matter. The question isn't whether money can move fast enough to keep the economy safe. The question is whether we've made the economy so fast that money can't keep up.